for me, it's just another absolutely shambolic display by government.
I tried to add up how many little tax changes there were, and I got to about 65 and got bored at that point.
This is where I get annoyed, because why should the people who are charlatans basically ruin it for everyone? Tackle the charlatans? Why are they not moving forward with any regulation of the tax sector? Welcome to episode 126 of the Tax Professionals podcast, the podcast that helps UK tax professionals become better tax professionals. This episode is on the government's November 2025 budget from a tax standpoint, where we rant and also discuss some of the key announcements. And as you might have realised from the start of this episode, there's a few of us in this episode debating this. We have Robin Milstead, Director of Tax at LKA Chartered Accountants and Director of MTD Therapy. We have Tom Bickle, Director of JP Blackmore and Director of MTD Therapy, as well as Robin. We also have Emma Rawson, Director of Public Policy from the Association of Taxation Technicians, the ATT. And the reason this episode has me and these three with me is because MTD Therapy invited me to join them in this session. I'll share a bit more about MTD Therapy later, but if you want a link to see more, head on over to the show notes for this episode at thetaxprofessionalspodcast.com/TTPP126. That's thetaxprofessionalspodcast.com/TTPP126, which just stands for the Tax Professionals Podcast, episode 126. Let's get into the rants and to the debates.
Thank you for joining us for the big budget rant. Probably just worth me going straight into saying our aim here is to unload, unpack, think through what it actually all means for us, all the announcements on Wednesday. It's not a technical update. We're not trying to go through death by PowerPoint with you. We want to obviously cover some of the technical points, but really it's about thinking through the results of our client comms, just our feelings about it. And I thought we could start with the thought of what was the aim of the budget, because that's one of the first things that you read about when you read the actual budget. The aim of it was, and I'll read it, to pursue growth, to get borrowing down, make the tax system fairer and fit for 21st century Britain, and cut the cost of living. So I'm going to push this straight out to our panel and say, do you think that the budget achieved its aims? Growth, a fairer tax system, etc. Emma, do you want to start us off?
If I had to take a sort of step back and think the overall feel of the budget, there were definitely some big sort of headline tax measures that we've all heard of. But what we got a lot of, which is what I feared would happen, was what I call tinkering. Lots of little changes around the edge. And I tried to add up how many little tax changes there were, and I got to about 65 and got bored at that point. So I think what we're seeing is just a lot of little bitty changes in the hope they add up to something. And then obviously
that exact word this morning talking about it. It's just the tinkering.
It's tinkering and it's bitty and it's round the edges. Few big things, but nothing, that controversial in the end. And the problem with that is what happened to all the great promises we had about simplicity of the tax system and trying to simplify things. If anything, this is taking it the other way, where we've got all these little tiny changes. And anybody who's been trying to read through all the documents and everything over the last couple of days, I'm sure will be in a similar position of not quite being, convinced we've got there.
Jack, how did the budget leave you feeling?
Well, to be honest, I didn't know about that statement in terms of what they're trying to achieve, but how can they think that they're reducing the cost of living when they're increasing again the national minimum wage, which always pushes up the cost of everything because businesses just pass it back on to their customers every single time. So I don't think it's really achieved those aims anyway, the ones that they said they were trying to achieve, for sure.
Tom, do you want to start our very first rant?
I'll try not to rant, but for me, it's just another absolutely shambolic display by government. I totally agree with everything that Emma and Jack said. More tinkering, more changes to tax. We've got a new tax rate to have to consider with our tax planning with clients now. Cost of living crisis has not been tackled. It's now why anybody would recruit someone under the age of 25 now is, I just think it's going to price them out of the market. And a shambles, really. I don't think they can look at the aim of the budget and say they've actually accomplished any of it. Rant over number one.
Times. Okay, so regardless of whether it does or doesn't achieve its aims, we had plenty of drama, didn't we? We had the OBR leak. I know that a lot of us are not fans of the general format of the budget, the behaviour in the House of Commons. I know that's a particularly highlighted point by you, Tom.
Yeah, I think, I'm not sure as accountants how many of us could say in the last month how many of our clients have contacted us because they're genuinely concerned about the budget. They're worried about how they're going to feed their kids, heat their house. So to see our elected officials behaving like really immature children, and, I was seeing, David Lammy sat there, incredibly smug grin on his face, disrupting everything. And then everybody on the backbenches all getting rowdy. I just think this isn't how it should be working. This should be everybody being quiet, being respectful, listen to the budget. I actually think that could have been covered in about 20 minutes if people just shut up and got on with it. So, yeah, I'm disappointed with that. And I just think the OBR thing, look, we've all sent an email accidentally beforehand. It does happen. It's not great. And I think, someone is probably going to get sacked for it. But why are we even bothering with the budget? If you've got great ideas that you think can really change the economy, just get on with them. We don't need to wait months and have all the speculation and all the rubbish that goes on beforehand. And what was that announcement she did like 3 weeks before at 8 o'clock in the morning? What was that other than scaremongering?
I'm with you on that. I found that OBR leak quite useful, actually, to be able to hear some of the points beforehand so that when she was actually speaking, you could go, okay, now actually we know a bit more about what she's saying and a little bit of that detail. To have that beforehand actually made life a lot easier in a lot of ways. And I really wish that they would publish the budget document itself as she starts speaking, because then at least the bits that you are looking out for, you can then tie it up with what she's saying. I think it wastes quite a lot of time having to sit and listen and then go, actually, I need to read this 152-page document as well. I don't like that aspect. Jack, Emma?
It'd be nice if they just broke it down into the tax areas as well, because then you could just go straight to the bits that are relevant to your area. Like, I don't care for 90% of them because I just work in employment tax, so I just want to try and find them, but they're like scattered and hidden just throughout.
So what do you do? Do you search employment?
No, because they don't even call it that. That's the thing. Like, some of them are like cars, for example. So you need to know to look for cars to be able to filter through like that. So you just have to have someone go through the full thing. I was actually quite lazy this year, and I waited for the LinkedIn post to come out before I went through, so then I could just shortcut the whole thing. Then I had someone in my team go through it as well before I started looking, so that saved me a bit of time this time.
Yeah, it's all been a bit of a nightmare this time round because we always have the silly season, don't we? The budget speculation. This one was worse than ever. I think partly because it was such a late budget, it just let people go for longer, and partly I do think there were lots of things being floated that to see how they landed. So there was a little bit of that going on as well, I think. And we saw lots of scare stories, didn't we? We saw wealth taxes, VAT threshold cuts, all of this stuff. None of it materialised in the end.
Tom, you start us off with some technical detail.
Oh, well, first off, the additional tax rate for me is the new one. Property and dividends going up 2% and savings being affected as well. From a tax planning point of view, I'm in the Southwest. Probably 90% of my clients, this is not going to have a dramatic effect on their tax planning from this area. But I think that for probably the rest of the country, it is going to have a more of a dramatic effect. So that was the big one for me, is that, and the talk of, like, we know now quarterly payments are coming. Like that's coming now. So those are the two big ones for me. What else is there?
Have you had any client comms? Have you had much back on the 2%? Those that deal with clients? No. So I have had a couple of clients already in touch asking a little bit about it. So evidently people are twigging that it's going to make a difference to them.
Yeah. I think the interesting thing there is that the dividend increase is coming in next year, but the other two are not coming in until 2027. And the property, it's actually a brand new rate of tax they have to create because obviously that's currently lumped in with everything else. I think that's one of the reasons why that's been knocked back, is because behind the scenes there's a bit of rewiring to go on in HMRC to accommodate a brand new tax rate. And then the other interesting thing, if you get really, really geeky like I like to do, is the changes to the order of set off and release.
Yes.
So the rules are, so basically they're going to change it so you can't set off all your reducers and your deductions against the higher income stuff, the higher rate stuff. So your dividends, your savings, your rental income, you'll have to set it off against everything else first that you've got, and then against those. So I think that's quite an interesting one that's gone under the radar.
I noticed that, and I thought that's definitely one of those devil in the detail kind of thing that was just popped in there. I wonder if the software guys and girls are hitting their heads against a brick wall for those kind of points, because I
think that one's not till 27 as well, so they've got a tiny bit of time. But, you're right about the software. They're all busy doing MTD and things like that at the moment. Mm-hmm. Sure, we'll come on to that later. They've got e-invoicing coming down the line. The more of these things they change, the more things they have to build in, and it just adds to the complexity of the overall thing.
Yeah.
Do we think that the HMRC is capable of delivering all this? That's my next question.
Are they capable of delivering anything?
Well, I mean, we're talking about MTD. We'll get onto soft landings in a minute. But realistically, if we're talking about how your tax reducers kick in, the software is going to have to be pretty elaborate at this point, isn't it? They're going to have to really make sure that the APIs are working for MTD. Then all of the structure is there with the software. E-invoicing, I would be very surprised if Craig wasn't in charge of e-invoicing once he's delivered MTD. I mean, that's going to be an absolute huge burden to get over for people as well, isn't it?
Yeah, I think e-invoicing, that one's being shunted onto the software even more, because we're not going to have this sort of triangular system where it comes through HMRC. It's all going to be what happens between the businesses. So I think HMRC's actual practical involvement in e-invoicing beyond support and sort of having a roadmap for rollout is not actually going to be that big a thing for them. I think they'll be very pleased from a delivery point of view that the changes to the setup and reliefs and the new property rate aren't coming in April next year. I think that would have been a really big ask. They're bringing it in from 27, 28. So they've got a little bit of time to build that into, the back end of stuff. So I think they'll be glad that there has been a bit of time taken to those. But yeah, it's an interesting thing because there's lots of other bits and pieces in there as well about monetizing collection and, changes to perhaps tax payments that we're going to have to look at as well.
So one of the bigger points as well, technically wise, is all the rate staying the same until 2031, fiscal drag, etc. Lots of rates staying the same. Now, I'm going to make the point that I always do on this, that I'm really sorry for fiscal drag, but really helps me because my brain doesn't need to remember more rates. I always wonder if I'm a bit alone in that. But I have found, at least now that we've had such a long time with the same rates, it's starting to get through to the clients. It's starting to mean that people go, oh, I can have about £50,000 before I get into a higher rate, can't I? And actually, in some ways, that's really, really helpful. So that would be my happy thing from the budget, which I also know is probably quite an unpopular thing to say that I like. Am I alone? Are we happy?
I think you are alone on that one.
Okay, sorry.
You might be.
I'm not happy.
I'll pay my extra tax just so I don't have to remember another rate. Fair enough.
I mean, maybe closer rate. They could just choose round numbers when they do increase it. That's why not just have it like a nice round number. So I can get it from that standpoint for sure.
I think as soon as pensioners receiving state pension start to pay tax on their full state pension, the personal allowance is wrong. That to me, that's just a moral thing. No one should have to do that. Their state pension.
Well, there's a whole big issue about that because that's going to kick in, I think, about 2027. That will happen on current projections. Yeah.
I think for a lot of people that are on state pension getting, if they're getting more than £1,000 in savings interest a year, good on them, basically. They're doing right, But I think they could just massively simplify everything. It doesn't need to be this complicated. And I think when you make it more complicated, there's more incentive for people to try and take advantage because they will find more loopholes because there are so much legislation.
Yeah, it's easy to get things wrong. I mean, even as a tax advisor, you don't always know what you don't know. And to make sure that you don't miss anything when you're looking into something, it's very difficult. I know people who have left the profession because they feel so uncomfortable with not being certain that they've missed nothing. I mean, that's if a tax advisor is finding the system too complicated, surely it's too complicated.
Just wait till next year in another budget and we can have it even more complicated. It's only as simple as it's ever going to be right now, right? Can we talk through maybe some, Jack, you were going to talk us through some the pension contribution changes.
Yeah. So I'm not sure how much you guys will know about this and the people attending, because it tends to be for like employers that have 50 staff plus usually, but so pension salary sacrifice has been around for many years, and obviously all employers now have to enrol their staff as long as the staff hit criteria to be enrolled into a pension. And the standard way of doing pension contributions is that the employer will put in a percentage and the employee will put in a percentage, and the employee's percentage will be just taken from their net pay essentially. Pension salary sacrifice is just a way that changes the way that's done, so all the contributions end up being employer contributions, The employee does ultimately foot the bill of it, but rather than take from the net pay, they have a reduced contractual salary. And what that did is it created a national insurance saving for the employer and the employee. The employee one was the big one, particularly now it's 15% as well. So that's been around for a super long time, and government kind of allowed for that to happen because they knew that people weren't saving for their pensions, and, a lot of people were getting older and not having enough to retire, etc. So they kind of kept it around. And not every employer does pension salary sacrifice. I always think they should, but there's still a lot of people who don't do it. Maybe they don't know about it, or maybe they just never got round to it, whatever it is.
I understand that not every pension provider allows for salary sacrifice.
I've not ever come across one where you can't do it full stop. It's just been trickier sometimes when implementing. But all they're doing now anyway is basically saying if you are using salary sacrifice, you can only salary sacrifice £2,000 and still get that national insurance saving, which is just going to be so complicated to deal with because now that payroll software is going to have to figure out how much tax relief is given, which is different to the amount of national insurance relief that's given, and then process it in real time. And £2,000 isn't that much money either for most people. If you're on maybe around 30k salary a year, maybe you're going to be fine. But, the £40,000, you're just going to be hit by this. So the employee's going to have less net pay because of this. The employer's going to have more costs. They've already had national insurance, employers' national insurance increased in recent years to 15%. They've had the threshold dropped so that they're paying more anyway. They've had national minimum wage increases. So from the employer's standpoint, this is just another massive blow, particularly for some industries where they have a lot of low paid workers, and they're already struggling businesses. This is just another impact that's going to make some businesses fold ultimately. And for the ones to survive, they're going to have to put up prices. Again, things are going to be more expensive. Eating out is already stupidly expensive as it is now.
Oh,
like £20 for fish and chips near me most of the time now. 20 quid.
Wow. So the 15% national insurance saving for employers, that's also capped at the 2,000
yes.
per
Yeah.
employee?
So I imagine the way that the legislation is going to be written is it's going to allow anything or make anything above the £2,000 that's given up. It's going to bring that back into the charge of earnings. It's probably going to make it treated as earnings for national insurance. That's how I see it working.
Got a quick question in the chat. Will this affect one-man bands that contributes pensions for a director? So outside of salary sacrifice, someone makes a lump sum as a director.
It shouldn't make any difference, no, because salary sacrifice is all about where there's an agreement to give up some money. If you're a director, usually, or in one-man bands anyway, you haven't got a contract that says you're entitled to a certain amount and you can just end up paying yourself what you want. So it shouldn't affect that. One workaround that I've been seeing bandied around a bit is that rather than take employees on, and let's say it's a 3% employee contribution, they can be in salary sacrifice if they want to. They just stop that, just offer them a lower salary and make it so that the employer pension contributions are more. So it's the same position as what salary sacrifice would be right now. But the problem is then people are going to see that they're on a lower salary and that's going to put some people off taking the job.
I'll tell you,
so I'm not sure.
I know an organisation that does whopping great salary pension contributions. Was it HMRC, 30% pension contributions? It's easy for them to take a nice big pension contribution. But do you think this is going to affect a lot of people with planning for their future, Jack? Because this has been the incentive for years, isn't it? The government can't afford to do all the pensions forever. You've got to invest in your own future. Do you think people are going to back out?
Absolutely. Well, I'm going to put less in my pension contributions anyway. I already kind of put not a massive amount in because I think the fact I need to wait until I'm 55 or 57, whatever the age is now, to take out of it is just too long for me. I want more freedom than that. So I put money into my stocks and shares ISA instead. But a guy I sit next to at work, he was ranting so much about this. He's in the fortunate position that he still lives with his parents though. So he can whack in loads of money now into his pension, get the tax relief and everything. But most people obviously live hand to mouth or very close to that. So they won't have the luxury of just being able to ramp it up for a few years now in advance. And let's face it, how many people want to think 30 years into the future? They just don't, do they? Most people don't. So they're not going to want to ramp it up now. One last thing I'll say on this, by the way, is I actually don't think this will end up coming in overall. I think they'll reverse it before it comes in. My thought process was I thought it could deter people from new employers from doing it now, which means that they won't lose more national insurance over the next 3 years. Obviously, the budget really is, they need to create money now. And I thought, what's the point in delaying it for 3 years when you need the money now? That didn't make sense to me. When I've spoken to a few other employment tax advisors, what they've said is they just think they're doing it so that when it comes to the next election, that they can reverse it and that would look really good politically.
I was going to say, because it's April 29, this one, is it, Jack?
Yeah, April 29, yeah. Can you believe 3 years'
we've
time?
We've got another election yet, yeah.
Yeah. Yeah.
Do you know how that feels to me, though, Jack? It's like me going outside, punching someone in the face, then picking them up and going, look, I've picked you up. That's nice of me, isn't it? Aren't I a good chap?
I
You know, it's
100% agree, but I actually don't think it'll come in. They do end up reversing quite a lot of things, don't they? So this is one for me that they're going to do it. They've given themselves 3 years to do it. So, I could see that happening.
You heard it
love
here
that.
first.
Yeah, you heard it here first. Well done, Jack.
Let's pivot a little bit. One of the changes that caused quite a stir in our office was about electric cars. Can you talk us through the changes there?
Yeah, so this was I think we knew it was coming because fuel duty receipts have taken a real hit. They've obviously been frozen for forever now. In fact, they've been frozen again until September 26. So you've got sort of dropping fuel duty receipts. You also have a drop in VAT receipts as a result because VAT's charged on fuel duty inclusive prices. So they were going to have to do something to change, to address that loss of fuel duty. So the one they've come up with is this sort of pay per mile. Effectively, it's called electric car vehicle excise duty, which I think is a little bit of a bad name because they're already in vehicle excise duty. This is like additional on top of vehicle excise duty, but we'll drop that. So how it's going to work is it's going to be 3p a mile for electric cars, 1.5p per mile if it's a plug-in hybrid. It's cars only. So vans, motorbikes, all of that, not affected. The fun bit is how they're going to collect it. So there is a consultation that was published on Budget Day that proposes that it kind of works in a 3-step process. So when you go to do your VED, your road tax, they will ask you to estimate how many miles you think you're going to do in the coming year in your electric car. You put that in, it then calculates an amount based on 3p or the 1.5p a mile, and you will either pay that in full at that point in time, or you can pay it over the year in sort of 12 monthly installments. Then when you come to next year to do your VED again, it'll ask you actually, okay, so you estimated so many miles, how many did you actually do? So you'll have to put in what you did do. They'll marry that up. If you've not paid enough, there'll be a balancing payment. If you've paid too much, you get a credit to next year's, because then, of course, you've got to start the cycle again and estimate how much you're going to do in the coming year.
So
it
if you're really
sounds
smart,
like
you're going to start with 0 for the coming year, right?
Well, this is it. It sounds like an honesty system at first, because I was like, well, how's that going to work? But there will be checks that are done.
Okay.
So the idea is when you go in for an MOT, they'll check what your clock says in your car. And then that will somehow get fed back to DVLA. New cars that don't need an MOT, they're going to introduce a new sort of check that you have to have done on the 1st and 2nd anniversary of registration, which will just be a mileage check, but will obviously come with a cost. So if you're not paying for an MOT, you'll be paying for something in the first couple of years of having the car. So that sounds all right, but actually in practice, it's really quite complicated because your road tax period, you pay your VED for, will tie up always to your MOT period. So actually, how are you going to compare the two together and decide if somebody's underpaid or overpaid? What do the DVLA do if they've discovered people have underpaid? Don't even get started on the issue if you buy a second-hand car of somebody.
This is something that Les has just raised in the question box, actually, that the charge is on the vehicle, not on the owner.
It is.
So then if you buy a car, that's insane.
And I think in the V5, you can, when you do the documents when you buy a car, it's optional to put the mileage in there. Now, I suspect what they will do is make that part of the requirement of the sort of paperwork that you hand over. But I think there will be people who get stung, absolutely. And the other great one I've seen is that we're going back to the good old days of clocking the mileage on your car, which people used to do in the analog days. There will be a lot of industry, I'm sure, of people trying to suppress what the mileage says on an electric car when they come to do the MOT. So it'll be interesting to see how that works in the end. Again, they're talking April 28th for this. There is a consultation out there. Watch this space. But I think overall, the electric car thing, we've seen them, as I said, brought into vehicle excise duty this year. The benefit in kinds are being taken away a little bit. We've got this. And then at the same time, talking about putting money into public charging infrastructure. What they're doing on the tax side isn't marrying to what they're saying overall in terms of policy. And it's just,
very
it feels
confusing.
a little bit. Yes. Sorry, that's my rant.
Oh, I love it, Emma. We want more ranting. So I'm going to get on my soapbox here. I live in a rural part of the country. The minute they introduce this, no one will have an electric car down here. No, everybody will stop because the incentive that they've been pushing to do this for years will be going from around here. This will only be the start. Once they've done this, they'll realise they can make money out of it. Then it will move on to diesel and petrol, where they'll be going, we want everyone to have electric or hydrogen cars in the future. So then everybody will be doing it. So you'll have huge swathes of the country that will no longer be able to afford to drive. there is no public transport routes in most of rural Britain that are reliable and good. So you are isolating more people. And as usual, I feel like government is doing what is best for London and saying the rest of the country can just, we'll worry about you later on down the road. The collection of taxes through the road fund licence, basically what this is going to be a nightmare. Rachel Reeves was asked today, how are you going to do it on the first 3 years? And she didn't even really know that an MOT isn't required for 3 years. So how was she able to come into that conversation? And I just like, there's so many other things we could be focusing on. Why are they doing this? And this is one where I was similar to Jack. I can't see this coming in. I really cannot. I think that the electric car companies are going to kick off so much about this because it will massively de-incentivize people. And when they're talking about making, I know in London, the congestion charges, they're talking about changing that, aren't they? Is that going to have an impact on car sales? And we all know that car sales do dictate a lot of tax law in this country. So, yeah, not happy, very unhappy about that decision. Should we move on to writing down allowances?
Yeah, go for it.
So we've all seen, obviously, the reduction from sort of the main rate of 18 down to 14. And I am even now getting questions from people left, right and centre about this 40% main rate for assets. Now, I'll be honest, I'm going to go to you for this one, Emma, because if you don't know the answer, then none of us should know the answer, to be honest. How is it going to work, Emma?
I must admit, when they announced it, my first reaction was, what is the point? Because, we've got the annual investment allowance. I think that covers about 97% of business expenditure in the UK. If you're a company, you've got full expensing. So actually, what was the point? Now, having dug into it a bit more, there's a couple of points here. It's quite niche. It's not the giveaway that they made it sound in the speech, for sure. So the big people who are going to benefit are people who have things that don't qualify for the AIA or full expensing now. A big one being assets acquired for leasing. So the leasing industry have been putting pressure on HMRC and Treasury for a few years now that they should be entitled to some reliefs. So that's one first group of people qualify. So anyone who's leasing out assets. Also, unincorporated businesses that spend beyond their AIA and can't get full expensing because that's companies only. Only a very small number of those, but there's some partnerships out there. I think farming in particular, they may benefit a little bit. So I think there's some discrete groups. And then the other one is second-hand assets that don't qualify as well for this full expensing. I think you can get AIA on them. So it's not the big giveaway it sounds. It's little bits and certain groups of people that are going to benefit. But most people don't spend past their AIA anyway. As I say, I think it's about 97% of businesses are comfy in the millions. So again, this is just
more tinkering.
Yeah, it's tinkering.
Yeah.
Mm-hmm.
Having
it did
something
feel like
to
on the day. Yeah, on the day that there was so many of us accountants going, have I missed something? Have I missed something from my training from years ago? How is this relevant to me? And it's because very few of us ever worry about exceeding the AIA.
Yeah. You don't get it on cars. That was a big one that people, I think, were asking me. It's like, well, great, no.
So, yeah, that's fun. And it does feel like that point was just being able to stand up and say something that sounds positive. Right.
And the other one that always annoys me because they keep extending it is the first year allowance for charging points, which I was like, why? Because they already get AIA or full expense. What is, there must be a very small, tiny little group of people who maybe don't get full relief on their charging point expenditure. It's just sticking another law in that they've got to remember to extend because it's time limited. But yeah, never mind.
This session is done in conjunction with MTD Therapy, which is a community of accountants and tax professionals that help each other out and also put on sessions like this one. Some are free and some are for members only. The other thing to mention is that if you want to become a better tax professional, improving your tax skills, you can take a look at the Tax Lab. The Tax Lab is a series of free webinars that I do. You can see more details about both of these by heading on over to thetaxprofessionalspodcast.com/TTPP126. That's thetaxprofessionalspodcast.com/TTPP126. TTPP126 just stands for The Tax Professionals Podcast, episode 126.
Let's pivot again from businesses to employees. We had some changes to benefits in kind that Jack is going to talk us through.
Yeah, are you referring to the flu jabs and stuff this time? Yeah, so employment tax has loads of really stupid kind of rules where if the employer provides you something directly versus then reimbursing you for incurring the cost, it can change the tax consequence and how you report it, which I've always found bizarre. But the Employment Tax Committee that I'm a part of for the COT has been lobbying that they just align this across the board, to be honest, because why should it matter whether it's reimbursed or whether the employer gets it and then provides it to you? It should make absolutely no difference at all. So an area where they have made some changes is with flu vaccinations, eye tests and home working equipment. So prior to this, if you would have reimbursed your employees for the cost of this, it would not have been covered by an exemption. Whereas from the 6th of April 26, if you reimburse it, it will be covered by the exemption. So actually the difference was it completely wasn't taxable or NIable before if it was reimbursed. If it was provided directly, but it was taxable and NIable if it was reimbursed. And now it won't be anymore, which is sensible. Of course it is, because why should it make any difference? The one thing that's never made sense to me either is with eye tests, HMRC seem to think that if you provided a voucher for an eye test, instead of reimbursing it and instead of providing the eye test directly, then that was fine. But when I used to read the legislation, I didn't think that was right. And actually, if you used to look at the explanatory notes around this, the explanatory notes actually say it was meant to cover reimbursements too, but the legislation wording was really poor and didn't say that. And HMRC obviously latched onto the side that would result in more tax being due. Of course they did. I always think unfairly. So yeah, this is a welcome change for me, for sure.
These are the kind of changes that we would like to see in the budgets, right?
Oh, absolutely. Actual simplification.
Yeah.
Actual simplification.
We've got it on eye tests.
Yeah, on eye tests and flu vaccinations,
for
those
ages,
things.
I know, Jack. Yeah.
Yeah.
You guys have been asking for ages at CIOT. We have at ATTs who were like, finally, we've only been talking to you for 5 years about this tiny point.
Is there a reason why
Your wins
something
where you
so
get
simple? Is there a reason why something so, on the surface at least, simple and correct takes such a lot of lobbying?
The cynical side of me says it's because when HMRC goes to inspect an employer and they find that they've reimbursed instead of given a voucher, then they can pick up on something, right, and be like, you've done something wrong. Because most employers and the finance teams that sit within them, they're not going to know that there's a difference between reimbursing and providing. They're just not. And it catches people out when people have just tried to do things right.
Yeah.
And so the cynical side of me says it's so that HMRC can raise extra tax with a penalty and interest on top of it. And also, I suppose, somewhat scare an employer into realising that they might be doing some things wrong. That's my cynical kind of thought. Why
I hate that answer so much that I wish I didn't ask, because that's awful, isn't it? That I can see it.
They do it a lot. I might go on a slight rant, but National Minimum Wage had an inquiry this year that we're dealing with in my team. They're in the care sector. So there's one company that employs people, and there's another company in the group that just owns property, which includes like just normal houses. And the owner decided to let one of their staff members rent out one of the houses. HMRC contends that if, as a consequence of your employment or your employer, if your employer lets you use their accommodation and you pay for it, that actually reduces your pay for national minimum wage. And so if it is the employing company that has the property, then absolutely they're right with what they say around that. But I don't think they're right when the property's in a different company. I mean, it's stupid that even if it's in the same company, to be honest, that's the case, but that is the case. And HMRC were trying to push in this one case that where the property is owned by a different company to the employer that's connected in some way, in this case by the same directors, that reduces their national minimum wage pay in terms of what they pay, which is just an insane thing. So their guidance states that very clearly, but when you look through the legislation, it doesn't say that. And, this is what they're like on inquiries. They don't really seem to care about what the right answer is in some cases, I don't think. They just care about what their guidance says. So there's sometimes when you just cannot get past them at all when they're so adamant that something's right, even though it's probably not. But anyway, so that's a slight side topic and rant.
On that topic, Jack, I'm sure I saw a message from Hannah in our chat earlier this week that was saying she'd had an email from HMRC, and it was almost alluding to the fact that payroll providers, or processors, have to check that everybody is being paid above national minimum wage. Does anyone else remember that in the chat? I can't remember. Was that the general gist of it?
Yep. Do we know if
that's also pretty much impossible to do just through the payroll software alone, because there's four different categories of workers for national minimum wage, and based on the category of worker you are, the calculation's actually different. So it's not possible to just look at the hours that someone's worked and how much they're paid and, you know, divide one by the other and come up with the answer. That it doesn't work like that at all. It's one of those areas that's way more complicated than people realise. It catches a lot of people out. If you just look at the government name and shame list around national minimum wage breaches, there's loads of super big brands on there all the time, all making tiny little breaches here and there.
If anybody's able to find that for me in the chat and pop it in the webinar chat, I'd really appreciate that, because I think I'd like to give that to you, Jack, to have a look at, because I'm sure Hannah mentioned an email from HMRC about PAYE and how it was going to become our responsibility as processors to check everyone was over national minimum wage.
Yeah, that would be madness, because that's a huge task. You really need a national minimum wage specialist to be able to do that, really.
And there's no legal responsibility there. It lies with the employer in the end for national minimum wage. You know, they'd have to bring in some new legal obligation or liability for it.
Yeah.
Scary.
I mean, I think, to be fair, your it's maybe not relevant, but your terms when you're running payroll should say that you assume that, you know, the national minimum wage is being met, et cetera, and passing the obligation back to them. You just probably don't get enough information to be able to check that. And that's a really complicated thing to check, to be honest, anyway. I mean, how do you even know that they've captured the right amount of working hours, for example?
Well, yeah. To me, it's always been the employer's responsibility. We're just the communication device between the employer and HMRC. That's it. Yeah, we're just reporting what should be going through, not deciding what's legal or not.
No, agreed. And this is where, like, some connected errors in a way can come through, because I think a lot of businesses think that the payroll provider will be able to determine whether or not a payment is taxable or not. If it's salary, of course, it's taxable. Of course, it's subject to national insurance. But what about some of the more weird and wonderful things? A lot of payroll providers don't even realise that some things might not be taxable, or they might be taxable even. But that's a separate thing. I see errors going through there because there's just assumptions by both the business and the payroll provider in terms of, you know, what the correct answer is in terms of tax, national insurance on things.
Yeah.
So one other little change in the budget was for the deduction of working from home expenses too. Jack, do you want to explain us?
Yeah. So if you remember from CTA exams, there's something called Section 336, which is the wholly, exclusively, and necessarily deduction, which is pretty much pointless being in the ledger, to be honest, because HMRC think that it's never met, apart from some very, very tiny cases. Never really understood their position around some of this, to be honest. But pre this announcement, what you could do is, if you were genuinely a home worker and your employer did not reimburse the extra cost for you working from home, is you could claim a deduction from the amount of tax that you were going to pay, basically. And I think it was £6 a week that they were just accepting was an okay number. So a lot of people were just putting £6 times 52 weeks through their tax return and claiming it back, even though they probably didn't meet the criteria for 336 to apply.
And that changed between COVID and now as well. So that is where I've seen it a lot, is when I'm taking over someone's tax return. I sometimes see that the previous advisor has still been carrying that on from COVID times when maybe they shouldn't. And I expect that's why they've made these changes now, because there's quite a few people still claiming on the basis that they were allowed to in COVID.
Although what they're doing is they're obviously stopping the people who were legitimate claiming it from legitimately claiming this now too, which does feel a little bit unfair too. But they're just doing a blanket, no, you're not allowed it. But
the other thing I think behind that is that they've had a lot of the high volume repayment agents, so the really dodgy firms that just put in claims for anybody, even sometimes people who have not engaged them to get refunds. It's been a real target for that. So I think it's just been so rife for abuse that they've spoilt it for everybody, really.
Yeah, but I mean, separate note, this is where I get annoyed, because why should the people who are charlatans basically ruin it for everyone? Tackle the charlatans? Why are they not moving forward with any regulation of the tax sector? That one is baffling to me. Why are insurance people regulated? Why are financial advisors regulated? But why is tax advice not regulated? It makes no sense to me. And I think it would make our profession much better as well as a whole. You know, we should be regulated. We are. It's closely related to financial advice, as a separate rant this is anyway. But yeah, I just do not understand why we're not regulated. Why are we not regulated?
Well,
totally agreed. Agreed.
That was something mentioned in the budget itself anyway, wasn't it? That they're trying to raise the standards of the tax advice market, but they will not regulate tax advisors.
I'll put this out there. Does anybody think the industry is going in a more positive place or a more negative place? Because I feel very much that the regulation and the AML compliance and all the changes, if you were coming into this now and you were looking at what was ahead, would you want to start from scratch?
I've said many a times I wouldn't want to be out there on my own for a start. That absolutely terrifies me. I don't know how all our therapy members are doing it. It absolutely blows my mind, the amount that you have to think about. It's bad enough for me to try and sleep at night just doing tax. And most of my work is compliance, not advice as well. So how everybody else is coping, I don't know.
Yeah. Do you know the one thing I find quite tough as well, actually, is there's so much out there now about like tax advisors that help with tax avoidance and evasion, et cetera, et cetera. Now, evasion, obviously, it's obvious where you're helping with that, but you could just be given what I would consider normal tax advice now and inadvertently get caught out by some of these regulations. And I just think it's making it so hard now to actually give proper advice that's actually helpful for your clients without being so worried that you're going to implicate yourself at the same time.
Balanced advice.
I think the one thing we have seen that's got better is there's fewer really egregious schemes out there, I think, than there were if I look back to when I first started, and probably some of the stuff that even bigger firms were peddling when I first started were pushing what you wouldn't do it now. So I think actually we're getting to a better place in terms of that. And if you talk about the sort of promoters of tax avoidance and those big ones, there's a handful of them left and most of them are overseas, which is why we can't quite get to them yet. So it's sort of a bit of a whack-a-mole approach. So I think in that respect, we're doing better. I think my worry at the moment is the new version of Somebody Down the Pub Told Me, which is, I saw it on TikTok.
Yeah.
Or, I think that thing of people thinking they can do stuff because a social media influencer has said it absolutely horrifies me. That's the worrying bit.
A couple of comments in the chat are also saying AI, obviously.
Yeah, and AI,
Yeah. Scary. I'm conscious of time, so we're going to make another pivot. One interesting part, which we've already touched on a little bit, and I will read this part again, was the government are taking steps to ensure income tax self-assessment taxpayers pay tax automatically via regular payments throughout the year. The government will require income tax self-assessment taxpayers with PAYE income to pay more of their self-assessment liabilities in year via PAYE from April 2029. My notes here say kill me now. Can you please just tell me that that's going to be one of the things reversed before the next election too?
We knew it was coming.
I think at first it's just for the people who are in PAYE and have some self-assessment income as well. So I think what we're almost going to see is coded out payments on account, if that makes sense, where you're sort of estimating what the years is going to be and then
more towards where we
out.
have the tick box at the moment to include self-assessment or exclude self-assessment income in the code. Is it just moving towards that becoming mandatory? So if someone has,
I think it is, but I think it's bringing it forward as well. So if you do that, it's sort of coded out from that point onwards. I think what you're going to do is say, okay, based on last year's liability, you had $5,000 to pay. So we're going to code that out over the coming year. And then when you do your SA return, we'll true up. So it's almost like doing a payment on account, but doing it through coded out, I think is where they're going to with that. It's the line at the end about there'll be a consultation on this and also more timely payment for those with just self-assessment income that made my ears prick up, because that's a much bigger thing to be talking about than, sort of playing around with that for people who are in both. So I think we'll have to wait and see.
We can't push you for quarterly.
I don't know. Yeah, I don't know any more than you do about that one, unfortunately. No.
Can we dip into controversy corner?
We love it.
Yeah.
So for self-employed people at the moment, we know they can go over a year without having to make any tax. And how many arguments have we had with clients where we've told them from day one, make sure you start saving for your tax now because you're going to have 18 months worth of tax to play in one go in that following January. Do you think they should move people to paying tax monthly based on an estimate? Scrap the quarterly payments on account, scrap the 6 monthly payment on account. You pay monthly based on your previous year unless you've got good reason to reduce your payments on account.
Do you know what? I don't mind either way. It's more that it needs to be clear and easy to administrate. I don't think many of us would have balked at the thought of quarterly payments for under MTD if that is just what they had come out and said. It just needs to be sensible, whatever happens. Monthly doesn't bother me. I think, there is a case for that. Some people prefer to do that. I have plenty of my clients prefer to pay as soon as they have the tax return just to get it off their mind, and monthly can help people.
And you can see HMRC have a real focus.
For it.
Are you? Have a real focus on debt at the moment and debt management. So a lot of what they were saying yesterday, if you look through it's coming through this we're going to have to try and pull in tax debt. And I think we're seeing this as a key part of it because people are getting to, as you said, way after they've started up and gone, oh, I can't afford the tax bill now. Oops. So I think it's inevitable. It's going to change in the end. I don't think it can stay the way it is.
Purely from a personal point of view, it would hopefully cut down on the number of conversations this time of year of, sorry, I'm to be the bearer of bad news. Yes, you definitely do have £14,000 to pay in 8 weeks' time, blah, blah, blah. That might make my job satisfaction increase a little bit more when that's not happening anymore. Good question, Tom. I liked it. But you know what? The one subject we haven't spoken about yet, and we've got 3 minutes left, is MTD.
Shambles.
Okay. Should we let Tom go first on his thoughts on the removing of penalties for the first year? Go on, Tom.
Well, I'm going to be lynched by Gabby for this, but I am fuming that they've brought in this soft landing. The 4 penalty points was already a pretty soft landing. They have been forcing us to bang the drum to tell clients that they have to be MTD compliant from April 26 if they're in that threshold. And I'm going to struggle explaining to clients that I want them to be ready for MTD. I want them to be starting with MTD. If they say to me, what happens if I'm not? I can't say to them there's any penalties. There's nothing. They can wait another year. And for some clients, that is going to be the difference between them spending £1,000 or not spending £1,000. And they are automatically going to choose the cheap option, even though I think there is benefits to digital accounting software. But for so many of my clients, there is none. There is no benefit. MTD does not benefit them at all. So they are going to not bother. And it means the following year, I've got more to worry about. So rant over, but the revenue have done it at a really weird time. I know that they want the openness and the transparency, but yeah, why do it? Let's just get on with it.
I spent a lot of time thinking about this because my initial reaction was not a happy one. Exactly the same. I think the timing is really tricky for agents, that we have spent time now talking to our clients about what's going to happen and having that stick there. And now it's a case of having to go back to the clients and potentially amend the way that we're speaking to them about MTD. Although I can see in the chat, Chris is saying, let's go with there may be penalties. I quite like that. I might use that. I think it's the right decision. I think that it's the right decision when you consider how many unrepresented people have absolutely no awareness of MTD. But I think it's a horrible decision for us in industry to navigate. And that feels very conflicting for me. The one thing I have considered is that for my clients, many of them are going to be doing their own quarterly updates with the proviso that if at the end of the year they're in a mess, I step in. And I think actually this plays really nicely for me. I look back and I think, okay, I have maybe played this correctly, because at least when I'm letting them do it themselves, and I'm going to encourage them to continue doing the quarterly updates even without the penalties there. I'm sure some of them won't. But at least now they're going to be doing that without consequence. And then I can step in and say, look, now it's going to be a consequence. Let me be involved if I need to be. So from my messaging side, I'm quite happy with it, but I still feel very uneasy that puts agents again in this position where the goalposts have shifted and we look maybe like we didn't know what we were talking about for the last year or so. And it's very frustrating.
I think I welcome it from a practical perspective because I think there will be people who are struggling. There's people who don't know. There will be issues, and inevitably when it comes to the first filings next year where people can't get it to work. It will save people having to put in reasonable excuse appeals and do all of that to try and get penalty points removed because they do stick around. You could get 4 and over a 2-year period. So I think I appreciate the timing. It is unusual, the timing. It's earlier than I would have expected it. I would have expected it to be a lot later. I think it's got to be a sensible thing. And I think the other thing is to note that you're going to have to do so. It's not that they just can do nothing for a year and file on the self-assessment. They're still going to have to file at least quarter update 4 and have the digital records to be able to do a tax return. So I think that's over the message of, okay, we'll have a go. If we don't quite hit the first few deadlines, there's no consequences. But we do still have to do this because we're going to have to be in the same position at the end of the year as if we had done. So I think it just takes a little bit the heat off. But I wouldn't be going, don't worry about it because there's no penalty points because there's still a legal obligation at the end of the day as well.
Yeah, I'll be pushing clients to go through it. If you are mandated from April 26, if you want to work with me, you get into MTD. Simple as that for me.
Yeah.
So I hope you enjoyed this budget rant with MTD therapy. I thought it'd be nice to share this one because it was both fun and educational. And I'm a believer that you learn things more if things are fun. If you want to become a better tax professional, progress, get pay rises, then take a look at the Tax Lab. The Tax Lab is my series of free webinars where I run through real scenarios that tax professionals face. For these scenarios, I provide my advice, guidance, and tackle them. All of this done live. Head on over to thetaxprofessionalspodcast.com/TTPP126 for a link of where you can sign up for free. That's thetaxprofessionalspodcast.com/TTPP126. There's a link to that too in the details section of this episode if you're listening to this in a podcast player like Apple Podcasts or Spotify. But that's it for this episode. I hope you enjoyed the episode and have taken away something useful to help you to progress, develop, and improve your tax career. Until next time.